I decided to find out if Ireland has a gold reserve and how much it affects the country's economy. We still need to figure out which country we live in. I found a specialist and asked him a few questions, and that's what we're about to find out.
First question, what does it mean when a country has gold? Well, when a country has gold, or a gold reserve, it is significant for several reasons. 1. Monetary stability. Gold reserves provide a country with financial stability. They act as a guarantee for the value of the country's currency. Historically, currencies were often backed by gold, the gold standard, meaning the currency could be exchanged for a specific amount of gold. 2. Economic security. Gold is a universally recognized store of value and a hedge against inflation or economic downturns. In times of crisis, countries with large gold reserves can use them to stabilize their economy or pay off debts. 3. International influence. Countries with substantial gold reserves are often seen as more economically powerful. This can enhance their influence in international financial institutions like the International Monetary Fund and the World Bank. 4. Resilience in crises. In times of geopolitical instability, having gold reserves ensures that a country has a tangible asset that can be used regardless of sanctions, currency devaluation, or financial isolation. In summary, having gold signifies wealth, economic security, and financial independence for a country. Second question, please give me the list of 20 countries in 2024 what have gold reserve. Answer. As of 2024, the top 20 countries with the largest gold reserves are 1. United States, 8,133.5 tons. 2. Germany, 3,351.5 tons. 3. Italy, 2,451.8 tons. 4. France, 2,437.0 tons. 5. Russia, 2,335.9 tons. 6. China, 2,264.3 tons. 7. Switzerland, 1,040.0 tons. 8. Japan, 846.0 tons. 9. India, 840.8 tons. 10. Netherlands, 612.5 tons. 11. Turkey, 584.9 tons. 12. Portugal, 382.7 tons. 13. Poland, 377.4 tons. 14. Uzbekistan, 365.2 tons. 15. United Kingdom, 310.3 tons. 16. Kazakhstan, 298.8 tons. 17. Spain, 281.6 tons. 18. Austria, 280.0 tons. 19. Thailand, 234.5 tons. 20. Singapore, 228.9 tons. These reserves are essential for economic stability, serving as a hedge against financial instability and currency fluctuations. Then it's interesting. What is Ireland's place on this list? Okay, as of 2024, Ireland ranks 95th in the world for gold reserves, holding approximately 12 tons of gold. What does this mean in the economic perspective? Good question. In an economic context, Ireland's relatively small gold reserves, 12 tons, ranked 95th globally, have a few implications. First, there's the limited financial buffer. Gold reserves are often seen as a financial safeguard against economic crises, inflation, or currency devaluation. Ireland's small reserves suggest limited reliance on gold as a financial buffer, likely because it depends more on other economic tools and financial assets. Second, consider the economic structure. Ireland's economy is heavily focused on technology, pharmaceuticals, and services, rather than traditional reliance on hard assets like gold. The small gold reserve reflects this modern, diversified economy that doesn't heavily depend on gold for stability. Finally, there's currency stability. For larger economies, substantial gold reserves can help support currency value during economic downturns. Ireland's small reserves indicate that it likely relies on the broader European Union's financial system, as a Eurozone member, rather than its own gold stockpile to maintain currency stability. Overall, in economic terms, Ireland's small gold reserve highlights its integration into the broader EU economic framework and a focus on a diversified, modern economy rather than traditional gold holdings. Is it possible to think that this fact indicates how dependent a country is on, for example, the European Union or any other union? Yes, it is possible to interpret Ireland's small gold reserves as an indication of its economic and financial dependence on the European Union, particularly within the Eurozone framework. Here's how. First, there's the shared currency and monetary policy. As a member of the Eurozone, Ireland does not control its own currency or monetary policy. The European Central Bank, ECB, manages the euro, which reduces the need for Ireland to maintain large gold reserves for currency stabilization. The collective strength of the euro, backed by the economies of multiple countries, reduces Ireland's reliance on gold. Second, economic integration. Ireland's economy is highly integrated with the EU, benefiting from trade, investment, and financial support from other member states. This integration allows Ireland to depend more on EU mechanisms for economic stability rather than its own reserves of gold or other hard assets. Lastly, financial safety nets. The EU and the Eurozone provide financial safety nets, such as the European Stability Mechanism, ESM, which can support countries in financial distress. This further diminishes the need for Ireland to hold significant gold reserves as a form of self-insurance against economic crises. In summary, Ireland's small gold reserves can be seen as a reflection of its economic strategy, which relies more on the collective strength and financial mechanisms of the European Union than on traditional reserves like gold. Did I understand correctly that countries with a lot of gold can leave the EU, such as the UK left the EU? Germany, France, and Italy can also potentially leave the EU without fear. Your understanding has some validity, but there are additional factors to consider when it comes to a country potentially leaving the European Union, such as the UK did. While large gold reserves can provide economic security, they're just one aspect of a country's ability to navigate the economic challenges of leaving the EU. Key considerations include, first, economic independence. Countries with significant gold reserves like Germany, France, and Italy have more economic security and could theoretically cushion the impact of leaving the EU. Gold can act as a financial buffer during economic transitions, helping stabilize currency and cover financial obligations. Second, broader economic factors. While gold reserves provide some security, leaving the EU involves complex economic factors, including trade relationships, financial market access, regulatory frameworks, and political stability. For instance, the UK had large gold reserves, but Brexit was still economically challenging due to the loss of frictionless trade and market access. Third, political and strategic interests. EU membership provides benefits beyond economic ones, such as political influence and security cooperation. For Germany, France, and Italy, the political and economic integration with the EU is crucial to their global influence. Exiting the EU would risk these strategic advantages, regardless of gold reserves. Lastly, interdependence within the EU. These countries are deeply intertwined with the EU's economy and governance. Leaving would disrupt these relationships, potentially causing more harm than the security offered by gold reserves alone. Conclusion. While large gold reserves could help Germany, France, or Italy manage the financial risks of leaving the EU, they are not a sufficient reason alone. The broader economic, political, and strategic consequences are critical considerations that make leaving the EU a much more complex decision than just the size of a country's gold reserves.
Now, I think you, like me, understand the difference between countries that have gold reserves and those that do not. It's like with people. Imagine, do you have a stash under your mattress or not? You feel much calmer and do not commit abrupt and inappropriate actions as you are a little financially protected. Something like this. Thank you for watching. See you in the next video. Be sure to like and subscribe to the channel.